All right, let's dive right in. Today, we're talking about a really cool but kind of under the radar financial strategy for Canadian homeowners. What if I told you that you could use your RRSP, yeah, your retirement savings, to actually pay off your mortgage, your biggest debt, way faster? Sounds pretty good, right? Let's get into it. You know the feeling, right? It's the great Canadian dilemma. You've got some extra cash and you're stuck. Does it go into the RRSP for your future self, or do you hammer down that mortgage and get that weight off your shoulders sooner? It feels like this constant financial tug of war, and it's tough to know which side to pull for. Okay, so let's look at both sides of the argument. With your RSP, you've got the power of compounding. That tax-deferred growth is like a superpower for your money. But then you look at your mortgage, and paying that down, that's a guaranteed return. You're literally saving yourself from paying all that future interest, and that's a sure thing. So you're either building up your assets for later, or you're freeing up cash flow right now. Which one wins? And here's why this isn't just some academic debate anymore. There's something called the renewal cliff that's making this decision super urgent. Think about it. A huge chunk of Canadian mortgages, something like 60%, are up for renewal in 2025 and 2026. A lot of people locked in crazy low rates back in 2021, and they're about to face a serious sticker shock. So suddenly, paying down that principal before you renew isn't just a good idea, it's kind of critical. But what if you didn't have to choose? What if this whole either-or thing is, well, a myth? What if there's a way to get these two goals to stop fighting and actually start working together? I'm talking about using one to fuel the other. Yeah, what if your retirement savings could literally help you pay off your mortgage faster? Okay, here's the secret. The whole thing hinges on changing how you think about your tax refund. Most people see it as bonus money, right? A little windfall from the government. But that's not what it is. It's actually your secret financial weapon, hiding in plain sight. Here's the deal. When you put money into your RRSP, the government gives you a tax break based on your marginal tax rate. That's just the tax you pay on your highest level of income. So that refund you get back, it's not a gift. It's a rebate, a direct result of the RRSP contribution you just made. And that rebate is what we're going to use as a debt-destroying tool. I know, fiscal arbitrage sounds super complicated and intimidating, but all it really means is you're being smart about the tax system. You're kind of finding a loophole. You use the RSSP contribution to get a big chunk of cash back from the government, and then you immediately turn around and use that cash to get a guaranteed win by paying off your mortgage. It's all about making the tax rules work for you, not against you. So this whole process creates what we're calling the double win strategy. A better way to think about it is like a wealth velocity feedback loop. It's a system you create where your money is literally working for you in two different places at the exact same time. It's growing your assets and shrinking your debts simultaneously. Pretty cool, huh? Okay, so how does this actually work? It's a simple three-step loop. First, you make that RRSP contribution. A little pro tip, do it in the first 60 days of the year so you can claim it on last year's taxes and get your money back faster. Step 2, file your taxes and get that refund. And step 3, and this is the absolute key, you take 100% of that refund and immediately put it on your mortgage as a lump sum payment. No stopping for a vacation, no buying a new TV, straight to the mortgage. Now, you might be thinking, wait a minute, will my bank even let me do that? Aren't there penalties? And the answer for most people is a big yes, you can. Pretty much all the big banks have really generous prepayment rules. Usually, you can pay down something like 10 to 20% of your original mortgage amount every single year without any penalty at all. And for the vast majority of us, our tax refund is going to fit comfortably inside that limit. Okay, enough with the theory. Let's see what this looks like with some real numbers. We're going to walk through a case study of a professional in Ontario, we'll just call her Sarah, to see the real-world impact. All right, so meet Sarah. She's making a good income, about $135,000 a year. So early in the year, she takes 20 grand from her savings and boom, puts it right into her RRSP. That's step 1, done. Now, because Sarah's in a pretty high tax bracket, that $20,000 contribution gives her a huge tax break. We're talking a rate of over 43%. So what happens? The government sends her a tax refund for almost $8,700. That's step 2, and that's our ammunition. And now for the magic moment, step 3. Sarah takes every single penny of that refund, all $8,682, and slams it right onto her mortgage principal. And get this, that one single payment saves her over, wait for it, $21,000 in interest over the life of her mortgage. That is incredible. So what's the bottom line? With that one move, she just cut 9 months off her mortgage. 9 months! Now, stop and think about what happens if she does this every year. You do this for just 5 years, and you could be looking at knocking 4 or 5 years off your mortgage and saving close to $100,000 in interest. And all of this is happening while you're also building up a $100,000 RRSP. That's not just a win, that's the double win.
Okay, I know this all sounds amazing, and it is, but we have to pause here for a second. This strategy is super powerful, but it is absolutely not for everyone. So before you get too excited and start moving money around, we need to do a quick reality check.
Let's be crystal clear, this strategy is not for you if you have high interest debt. I'm talking credit cards. Paying off a 20% interest rate is always going to be a better return. So tackle that first, period. Also, you absolutely must have a separate liquid emergency fund. Your RSSP is not your emergency fund. And finally, this strategy works best for people in higher tax brackets. The bigger your tax rate, the bigger your refund, and the more powerful this whole thing becomes. So, to wrap it all up, let's just lay out the pros and cons. The pros? They're huge. You're building your retirement savings and your home equity at the same time. You're slashing the total interest you pay on your mortgage. It's a fantastic 2-for-1 deal. The cons, though, are real. This takes serious discipline. You see that big refund pop into your bank account, and you have to resist the urge to spend it. It has to go straight to the mortgage. And remember, that money is now locked in your RRSP until you retire, so you need to be sure you're on solid financial ground before you start. So, as we head into tax season, I want to leave you with this one thought. That tax refund you might be getting, it's not just found money. It's a strategic asset. It's a tool you can use to build your future and demolish your debt at the very same time. So the question is, what are you going to do with it?